Well, happy Thursday, everybody. Welcome to our long verticals and diagonals webcast. I'm Connie Hill. Happy that you join me here today. I see some friendly folks joining us that I see time after time. I'm so happy that you're here. And sometimes we have new folks joining us. If you're brand new today, I want to welcome you as well. And you could put a little note in the chat. Let us know that you're new. And these guys will be so friendly to you, you won't believe it. I am joined in the chat by my good friend and fellow coach, Ben Watson. Ben is here to help me answer some questions as they might come up, because I'm going to keep my eye on the chat, see what your questions are. There might be some that I can't get to. Ben will help field some of those questions for me. And I hope you're following both of us on X. I'm Connie Hill CS. He is Ben Watson CS, and we'll post educational content out in our account. Things that we're noticing that we think you might find interesting, then we will post about that. Let's go through our disclosures and lay out the agenda, because I've got a pretty full class planned for us here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today, just know it's for information and educational purposes only. Don't consider it a recommendation of any type. We're going to be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Thinkorswim. It might not look the same as the web version, and it's not going to look the same as a mobile version. Okay, but those same trades that you're practicing out in your Paper Money account, you can see on those other formats as well. When we talk about probabilities, keep in mind they're theoretical in nature, never guaranteed. Past performance of any security or strategy does not guarantee future results or success. One difference in the Paper Money is that it will not assign a short position early. That's not the same way in the market. The market can and will assign options early. So I don't want you to have that false sense of security that you're never assigned on a short option if it goes in the money. All right, let's see. Paul Montgomery says, first time here today. I don't know about that, Paul. Your name is very familiar to me. I don't know that you're the first time that I've ever seen you in any class, but maybe this particular class this day. This could be your first time. That's true. Justin, your first timer here. Excellent. Nice to see all of you, whether you're a veteran or new. Happy to see you here. Today, we're going to focus on one of our strategies for the most part. Here we talk about long verticals, which we talked about long call verticals last week. Today, we're going to talk about a long call diagonal, and it's a strategy that I think many could use, but it sometimes is a little bit more detail of a trade and not as clear cut as some other trades. And there's a lot of different ways you can trade it. So I'm just going to show you one approach today. All right. We always want to talk about the impact of price, time, and volatility. And of course, we're going to look at some examples out in Thinkorswim. Now, just in general, with long verticals and with diagonals, there's a few things to keep in mind. The biggest one is the price. Okay. And typically what we want with the price is for it to be at a short strike price or beyond it by the time expiration comes along. Now, it'll be true with diagonals as well, but a diagonal, if you're not sure, you'll even throw what that is where we have a stock or a long option of one date and a short option of a different strike and a different date. Okay, and that's kind of why they call it a diagonal. They can be impacted by time as well, because we're working with options here, so they're always time impacted. But sometimes with a diagonal, the deltas will maybe offset each other a little bit, kind of like they might do in a calendar. And so that's helpful to know that maybe it's not completely super directional. That's what I'm going to call it. They're not super directional. We're going to be slightly directional. All right. Volatility, directional options typically are helped by rising in volatility. That's because in this case, we're going to have a long leg that's further dated out. And so if implied volatility rises, that could increase the price of that option, which would be beneficial on that long leg. All right, now I'm curious, how many of you are comfortable with the idea of a diagonal spread? Go ahead, chat into me if you're comfortable with the idea of a diagonal spread, or if you trade them, tell me that too. Tell me that, yeah, you've traded some, or maybe you haven't traded some. All right. Stay Gold says SLB trade was a success. That was our trade from last week. We're going to be taking a look at that as we examine some positions. How many of you have heard the term a poor man's cover call? You go back to your concept of what is a call. We have an underlying stock position, and then we sell an option against it that is a little bit out of the money. And we know that we might give up some upside potential for that. But in some certain situations, we might be interested in doing that. Well, what if you didn't have to fork out all the money for the stock position and you could just do that with an option position? That's what a long call diagonal will be. So some of you are comfortable with it. You're pretty new, says Mega. That's all right. We're happy that you're here. Some of you are no's. Chris says middling comfortable, kind of middle of the road there. Okay. Yes, comfy is my new bet. Hey, that's a good feeling to have. All right. I'm glad a lot of you are familiar with this strategy. There are a lot of different approaches that we're going to take in this class. Today, we're going to be kind of vanilla, kind of straightforward as far as the long call strategy, long diagonal call goes. Let's look at this as well. Let's jump over here to Thinkorswim. You guys know the market's up a little bit today, hit a new high on Monday. Yes, we're looking at the S&P here. And you can see by the trend lines, you can see, yeah, we're still making higher highs, higher lows. And when we have a little bit of a retracement, it really doesn't go that far. Pulls back a little bit, but not, yeah, we really haven't had major corrections in this trend for a little bit of time, for several months. And today we are up again a little bit. Now, upward trend continues. If you were looking at yesterday and you saw this long shadow on the candle here, you might have thought, that's a hammer candle. Hammers many times will mean reversals because the bears had it down here. And then by the end of the day, the bulls pushed the price back up. Okay. And that's why you look at that and go, oh, okay, maybe the market tomorrow will be up on the day. So it looks like our S&P is up. Let's look at our NASDAQ. It's kind of a similar thing on the NASDAQ, except it didn't put in a new high recently. That new high was back in October. We still haven't got past it, or it hasn't got past it. It's not us, it's it, okay? But again, a little bit of a hammer-looking formation. So the idea that, okay, maybe things will, as far as short-term momentum, turn around. But the 10 days moving up, that's the blue line. The red line's my 30-day moving average. It is moving up as well. And what would we expect here on the VIX? Would we expect it to be high? Would we expect it to be low? Hopefully you're saying low, right? Because it has been down in lower territories, not as much skittishness in the market, not as much long put buying for hedges and for covering. And so, yeah, that volatility is generally low, which means option prices across the board shouldn't be quite as expensive, shouldn't be quite as big as spreads, but sometimes we're still going to see that in individual stock positions. All right. Let's see. Noodlebrain says, I've seen people do leap long verticals, much like buying a 20 and selling a 50 expiration in 2027. Do you ever do those types of trades in this class? We might do that at some point. It's probably not the most common approach that we might look at, but we certainly could entertain that, because technically it really doesn't matter how far long out you go. And in some instances, yeah, you might want to go out a great deal of time in order to sell options against that longer dated option. Yeah, we will look at that. Ben's put in a class there for you. It said Rachel did a class on leaps recently, and he put that out there. That was in part of her long options series. So thank you for doing that, Ben. What about the previous hammer candle? Maybe you might have typed that in before I mentioned the hammer candle, and then we may have gone right to it. Okay, so overall, we're looking at a more bullish environment. So we're going to be looking at more bullish examples. Okay, let's do a quick thing here, which is let's just take a quick look at our trade from last week. Last week, we really did a comparison between a long call and a long call vertical. Why some people might consider wanting to do a long call vertical because of the buffer that it can give you. And I think we're going to see a little bit of that in this SLB trade here. The day we got in last week was right here, this second oval. This first oval was a different class, different trade, okay? But this was our class, our trade here. And what we were seeing was just, the stock had gapped up, it pulled back a little bit and was just kind of bouncing out of it when we had our class last week. And so we put on a long call vertical, and I like to mark them up. I like to put them out in my chart so I remember what exactly is the trade we have going on here and what's the current price in relationship to that trade. So I've just put a line out here, and this is my abbreviations, okay? LCV, long call vertical, and then I say what the strike prices are. We've got a 42.50 and a 45 here, both expiring February 20th. And then this 45 line is basically that strike price that is short, where we want the price of the stock to get beyond. And many times in this scenario, when you're setting up a long vertical, you do typically need movement. They don't have to be structured that way, but many times they are. Kind of maybe a little bit of more aggressive approach with the vertical versus a conservative approach. So let's see how it is doing. I think it was Staygold mentioned earlier that it was working out for us. And let's just look here on this. Let me clean this up a little bit so we're not so distracted. SLB, there's our strike prices, you can see. We are up fairly nicely in the trade. We're up about 57% here. Up over $1,000, a little bit of that today, but clearly some good movement in the course of the last week. So our long option, you can see here, yeah, it's definitely gone up in value because the price of the stock has moved up. I don't think volatility has changed that much here. We got in on this day. So maybe, yeah, actually it did ramp up a little bit. That would have helped the long side of that trade. Well, what about our strike that we sold? Well, we bought in $1.35 on that call, but now it is priced a little bit higher. So this one, yeah, we are losing a little bit of money on. However, we're happy to have it as our buffer. Okay, we're happy to have brought in that premium. We're happy to have brought that down, that net debit down. Really, the trade price here was only 121. So even in a smaller account, which some of you have asked me to talk about, even in a smaller account, that might be something that is position sized well enough for you to do. So it's working for us. We've got an order sitting out here. Where's our SLB? That if it gets up to 408, the value of that spread of, no, I'm sorry, I'm pointing the wrong one. SLB right here. 211 is what we're interested in getting out. I believe that's about 70% of the max gain. It's at 193 now, so that may hit before the end of the week if this stock continues to just kind of grind higher. So we're going to let it work, okay? And some of you, if you were happy with that gain, if you said, I'm happy at 50% and it's showing at 59, you might be somebody that says, oh, I'm already going to get out. I'm going to take that profit and run, go find a new trade. That would be fine as well. But I think in our case, we're going to hold out, see if we can get a little bit more mileage out of it. The stock isn't really showing signs of fatiguing that much, right? It's kind of hanging up here. So we'll be happy about that. Let's see here what this questions might be. Chris talking about a book he read or something on a particular type of trade. Chris, I'll take a look at your comment. and see if it's something that might be useful to incorporate in our class here as we go forward. I won't be incorporating it today, but I'll go back and look at your comment and save that. I am going to comment at some point in our discussion here today some requests that I have from a couple of you that have come in during the week. All right. Louise, I don't know if it's Louise or Louise, but I think it's Louise Charles. You say without early assignment, it would be unwise to leave. It would be unwise to leave to expiration. Many times in lots of our option trades, we don't want to go to expiration, do we? We don't. We want to be out well before options expiration. And, you know, we're still early in the month of January. And if that went up and hit our target price that we're interested in, and we got out early, even before we even made it to February, we would be happy campers. Sooner we hit those profit targets, the happier we are. Absolutely don't have to wait till the option gets close to expiration. All right. I think Ben, between Ben and I think we've got it covered. Thank you for helping me out here, Ben. Okay. Let's talk about a new position. Our stock that we're going to work with here today for our first primary position is going to be Morgan Stanley. I'm going to show you the setup of Morgan Stanley. As you know, we're into earnings here. The banks, some of those major banks have been announcing this week. Morgan Stanley was this morning. Apparently, the market liked what they had to say. Earnings were estimated at 2.41. They came at 2.68, so they came in higher. I did not go out and read the notes on that, but apparently, whatever they said, the market is responding favorably to us. And we can see it's been trading in this nice little channel here for a couple of months. And here it is today down at the bottom edge of that channel, going through the midpoint of the channel, and with still some room to possibly move up. But a lot of the move may be done for the moment. We don't know for sure. And so maybe our bias on the stock is that we're expecting a little bit of bullishness, but maybe not tremendous. Okay. And so we're going to, instead of doing, say, like a covered call on it where we own the stock and sell the call against it, we're going to go out and select a longer dated option further out in time. And then we're going to sell against it shorter dated call options with the intent of just kind of bringing in some premium, and lowering the net debit of the cost of the trade. Okay, that is the concept here. Let's go explore this. We're going to go to the trade tab. And what I've decided to use here today, I picked through the weekly options. I'm not liking the spreads on some of them. Some of them are a little too wide. Look at this, 980 by 1240. I'm not liking that. That's just a little bit wide. Some of these that are a little bit further out of the money, maybe not so bad, 445 by 475, but some of these they were just a little bit too wide in the spread. So I don't mess with it. Just come out here to the monthly option. Typically, the monthlies have a lot more open interest, and that's why the spreads can be a little bit tighter. And so February 20 here is going to be our short leg. Okay. And on this, some people might sell in the money or out of the money. And in our case, we're going to sell a little bit out of the money with the idea that we are interested in letting that premium come in, help bring down the cost of the longer dated option, which we're going to do in May, just so you know. But we're going to start our trade out here. And when you go to place it on the platform, you start with your short leg. Okay. Our short leg in this case, let me make sure this still makes sense for us to do the 195. That's what I had pegged earlier today. Yeah, we're going to go with that 195. It's about, what, $6 out of the money from where the price of the stock is right now. It's a 38 delta. With the weeklies, you will get some single dollar denominations to work with sometimes. Guess not in those ones. Yeah, I guess these are still just $5 here. In some stocks, you'll see that you can get some dollars in there, and you can kind of fine tune maybe the strike prices you want to use. When they're spread out by $5, maybe not quite as easy to do, but the stock is almost a $200 stock, so $5 increments really are reasonable for that price of a stock. Okay, so let's go with our 195 here. I'm going to do a right mouse click and I'm going to say buy. We're going to come up here to diagonal. Now, Thinkorswim doesn't know what strike price we want to go to and what date we want to go to. We just told it what our short leg is going to be. We've said, hey, it's going to be our 195. So it just goes out and it picks the next series out and it picks the next strike out. Okay, it doesn't mean you have to go with it. We're not going to. Okay, I mentioned we're going to use May. Okay, and in May, what we're going to do, let's see if this still makes sense for us to use this. I was thinking of looking at doing the first in the money strike price. In this case, that's going to be the 185. And you can see, yeah, it's a little bit more of an expensive option because the price of the stock is higher. So it's nice that we might have money coming in, that February option, to lower the price of the longer option. And the hope is this. The hope is that we can sell the February option. Great. We can go sell some additional ones along the way after that. Now, had I found some liquidity out in these, say the 15 days to expiration or 22 days to expiration, we could have done that. But it was just kind of wide here. Can you see that? Like 159 by 198. So almost about, almost about 40 cents on a $1.98. That's more than a 10% spread. Okay. And so just kind of showing you what I was looking at and why you didn't choose it. Okay. So here, let's go with, we're going to go with the May 15s. And out we go here to May 15. And we're going to do the 185 strike. Now, do you always have to configure a diagonal with an at the money option as long and an out of the money option as short? The answer is no, you don't have to. In fact, we will do some example trades, but we'd spend the whole session on it doing the flip of that. Maybe selling in the money and buying out of the money. It's a different mentality and it's a different approach in the trade. Now, let's go ahead and look at this on the risk profile here. Let's go to the Analyze tab. I probably already actually have that loaded up in here. So here's our May 185 and our February 195 short. And on the risk profile, I think probably a lot of you are accustomed to the risk profile, but we might have some folks in here that are a little bit newer to the risk profile. So I do want to point out some important parts of it. Let's see. Yeah, Randy says, you know, I've noticed spreads have been wide even with liquid stocks. And do I have a theory on that? I've noticed the same thing. I have noticed in some stocks where many times they are liquid, they are tighter spreads. I don't know why, actually. Could it be that the stock was going into earnings, which they just announced this morning, and maybe they were still a little bit wider? That could be a little bit of it. Maybe after they get a little bit past earnings, maybe things will kind of flatten out and go, I'm going to say a little bit more normal, regular, what we would expect. But not really sure on that one. Now, Noodle Brain says, well, wouldn't we lose money if the February sold call gets called away? 195 minus 185 is less than the cost. That's a good question, which is a valid question. You always want to know, on my short, what do I have to do? What do I maybe potentially have to do? Well, we may potentially have to put the stock to somebody else, which means acquiring it so we can put it, but we could do so at 195. But our objective here is if the price of the stock goes up, that we can see where its max profitability is, right? Its max profitability is on this teal colored line right up here at the top. But I want to change a couple of the values that are in here, and I wanted to point those out. This value here, we want it to be for the options expiration date that's the furthest out. Now, when we're working with verticals, it's the same it's the same date. When we're working with diagonals, they're different dates. So the date that we want up here is going to be this, basically this May option. And then there's a date field down here, which is supposed to represent today. It looks like it's a little bit behind because today's the 15th and this is sitting here on the 12th. So we'll change that. And so this purple color line, magenta, I guess we're going to be real technical about. I think that's magenta. It represents our profit and loss as of this particular date. So sometimes we might look ahead. Sometimes we might put in scenarios and decrease some, increase or decrease implied volatility, increase or decrease the price. We can do some what ifs scenarios in here. But let's just get this set up for just the basic right now. So let's come out here. Let's change this date. There we go. We want this to be our later dated one. So that is going to be May 15th. So that's going to be the 16th of May right there. And down here, let's change this date. Let's make this be, let's put it at today's date right now. And then I'm going to set the slices to show us our break-even point at options expiration, or at options expiration. And this is helpful to see, where do we make money? Where do we lose money? This gray shaded area in the middle represents what? Those of you that are familiar with the risk profile, what does that gray shaded area represent? I'll give you a second to think on it and answer and tell your computer screen or your dog, or feel free to type it in. Okay. It represents one standard deviation from the mean, which is where 68.2% of the data points are going to go. Basically, where the price is likely to fall around the money, at the money, on either side. So this particular trade has a break-even price. Looks right here, at least right now. And these values can change on diagonals and calendars. Okay, but as of this exact moment, what it's plotting is looking like around, okay, so I'm going to be a little fluid there, 187.05, and this looks like 223 and some change. Okay, so if the stock were to like go way, way, way high, have super duper great news, that would not be good news for this trade. Same thing on the downside. If this stock were to plummet, that would not be good news on this trade. But what if it holds its own? Morgan Stanley had a decent earnings. So is it likely to be bullish? Well, we hope so. We don't never know, right? We all get to see what the market does to us all at the same time. But ideally, what we might want to do is at options expiration, which isn't for several days out in February, be around this 195. Now, it's kind of hard actually to kind of get it exactly there. And so many times what we'll look at is we'll say, well, if it's kind of a range, right? If it's in a profitable range. Right now, the net debit on it is 1148. But, you know, maybe what if we could maybe buy it back when it's maybe close to 195 and then maybe sell a different option against it, bring in some more premium. We could either use the same strike price, we could use a different strike price, and it'll just kind of depend which one we might decide to use. It'll depend when we get to that point, but we're going to look for it. Now, some people might also want to put a profit target in. Maybe they say, you know, on that trade, if I get a 40% return, I'm good. Let's close down the whole trade. That could be one approach. The approach we're going to take with this one, because it's going to stay in our account for a little bit of time, is we're going to take the approach that we like, that we received some money off this February option, and we would love to sell maybe some weeklies in March when the spreads tighten up a little bit nicer for us. That is going to be our plan, is to hold on to the long leg as long as the stock is bullish, as long as it's not changing trend on us, then that's our intent of the trade. Now I'm going to see what kind of questions you've got out here. It looks like Ben has been kind of busy answering some of those questions. So let's just take a look if there's something that I need to address. Jerry wants to know, is it too early to trade since earnings came out today? If you have a rule about that, Jerry, maybe it's too early for you. But because the news is out, the majority, not all, but a lot of the implied volatility has come crushing out of those options. And we kind of have an idea that, okay, the market's reacting favorably to Morgan Stanley. Market likes the news, then we have every reason to be bullish on it. But if you had a particular rule about it, I guess you could not do it, but I don't think you need to be skittish. Maybe I'll just put it that way. And so Sai says, it's a bullish trade. It's a slightly bullish trade, okay? Just slightly. Because you can see if it goes too far, that's when we start getting past our break-even point on this side. So if this thing had magnificent news, which it would have to be magnificent, to really propel it past beyond 222, 223, back over here. Yeah, if it's too good of news, it's not good for the trade, and we would want to shut it down. Okay. Expectation here is maybe it made a lot of that move already. Where is 195? 195 out here, say, it could hit up here in the next few days. We'll see if it really does. It could kind of do what it does here, just kind of inch along, right? Little bit, little correction. Then, a little bit, little correction. Okay. It's typically hasn't been one that has moved a lot. Okay. We'll just say that. And that's why we might consider it for this strategy. BC wants to know, would you prefer to open this on a green or a red day? More likely than not, it doesn't have to necessarily be a green candle, but you would want the stock to be in an uptrend. And some people might decide, I want to get in when I would normally enter into a stock position, or I would enter into a long position. So some people might wait for a bounce off support. They might wait for a breakout. If it's maybe up against resistance, they might want to wait till it breaks out and kind of gives them that technical entry. But because we're working with a couple of deltas that they're close to each other, they're not super close, but they kind of offset each other a little bit. Okay. I'm going to say both of them, well, not both of them are bigger deltas. Our longer dated delta is the bigger one. Okay. Let's see. What is the probability to move right side curve? What is the probability of that? We could look, I guess. I think what you're saying was the probability of it. We come back to our Analyze tab. What's the probability of it? Let's see. I set the prices to break even, and you may or may not see the numbers because they're kind of in orangey yellow color, right, in shading. Probability of not making any money on this and it going beyond our top value and putting us out in a non-profitable area. It looks here about 14.72%. The bigger amount here that it would cross the threshold of being unprofitable with the price of the stock dropping is about 45%. And so probability of being between our break-even points is around 39%. Okay, so that's why I say it's slightly directional. It's not major directional, right? If we're a long vertical like we did with SLB, we wouldn't care how high it went, right? We'd be happy campers. Higher it goes, sooner we could get to a point to lock in some profitable gains. But in this one, yeah, that's why it's kind of a neutral to slightly bullish, but we're still putting a bias on it here. So think of it kind of as the covered call. Instead of buying the stock, putting in 198 shares or 198 bucks or whatever it is right now to buy the stock. I guess it's not 198, it's 191. I shouldn't exaggerate, 191. We're putting out for a longer dated option to take the place of the stock, which it doesn't represent the stock and it doesn't have stock rights because it is an option, okay? but our net outlay is significantly less. And our hope is to sell some more against it, sell some more, sell some more. One thing you need to be aware of in Thinkorswim is you're going to have to keep track when we roll the strike. We're not at rolling position, obviously, because we haven't even sent it in. But the rolls do not get tracked in the overall balance. So we want to collect those and put them on like a trading journal. Okay, let's see what it is right now. Okay, it's going to cost us a little bit more, $11.93. Let's go ahead. We're going to submit this trade. We're going to hit confirm and send. We'll just do one contract on it here, but we'll put it in our bucket called long verticals and diagonals class. Okay, and this is going to be the first one that we're going to start out with. All right. Someone wants to know, what's the rationale of doing this diagonal trade versus taking a long call? The rationale, let's go back to the trade tab here, of this strategy is that we think it's bullish. We don't think it's incredibly bullish, but we do think it's bullish and we want to capitalize on that. We do think it has a nice trend going out into the future, which is why we went clear out to May for this leg. And we want to sell against it so that maybe we can lower the net debit as the trade goes. Okay. So if we had just done the long option here in May, was it going to cost us, if we went with the pure ask price, $16.20, maybe we get it for $16. Okay. But by selling that option against it, look how far it brings down our net debit here. That brings it down to $11.93. Okay. So that's kind of the motivation. That's the rationale. Okay. I'll let Chris, I'm not sure what that is about. I'm going to let Ben help you out with that in the chat. BC wants to know, what are the pluses or minuses of choosing a longer dated long position? For example, if you bought the LEAP call out in January 2027 rather than May 2026. One, if you were to buy a LEAP, which you're obviously free to do, for you, that would mean that you think the stock is going to be long bullish. Well, it's going to be bullishly for, you're thinking a long period of time, right? If you're going to go out and buy options that expire in January of 27, right? You're thinking this stock is going to go, and maybe it will. Let's look at, say, like just the last 5 years, what it's done. Financials have not been on a big roll, have they? I mean, over the last 5 years, they've just kind of been some ups and downs, clearly going up overall. But right now, in the stretch that it's in right now, it's looking fairly bullish. So if you wanted to, you absolutely could go out longer if you wanted to. Okay? Some people do. Doesn't mean you have to, but yeah, some people might do that. Downside would be you might have more at risk because the premium of the longer dated option would be more expensive. And so at some point the trend might end, right? We never know when, but we see trends last for a while and then they pull back, maybe have some corrections, right? And so if the stock were to do that before January 27th, or even say before December or November of this year, then you could be looking at a bigger loss on it, but you also may have been able to sell more against it. Let's see if we go out to what you were kind of looking at here, January of 27. Okay, so these options, say for our same strike price, say 185, it would be like a $26 option. Okay, you can see there's lots of open interest out here. People are doing something with it. Okay, we can't say absolutely all of these people are buyers because we don't know that. But I think as somebody is learning this strategy, I think going out that far might be a little bit harder to learn, but maybe not. You could try it. We've all got paper money. This is just an example trade. And to feel more comfortable with the strategy, I would encourage you to paper trade. Do paper trade these examples. Now, I need to cover a couple of other things here while we have time. Number one, I want to show you where can you find this information? Where can you find information about diagonals? Okay, they are a more complex trade because there's a lot of ways you can structure them. Okay, we're kind of going with a straightforward approach today, kind of like, saying poor man's covered call. Come over here to education. Come over here to this education after that. And then come over here to, I'll bring it up again here fresh, courses. And then you're going to come on down, and the one for diagonals is going to be in the non-directional option strategies. The verticals is going to be in the directional option strategies, but the diagonals are going to be here. Okay. And it'll talk about what is a time spread, because calendars and diagonals are time spreads. So it talks about that a little bit. And then it gets into the diagonal more specifically in the second chapter. Okay. And really, for a lot of you, especially if this is newer to you and you're kind of like, I'm not quite so sure about it, go through this information. It'll help you a ton. I'm so glad that we have courses out here for you, because really what we do is we teach and reinforce what you're learning in the course. Okay, teaching you how to apply it when we have our session together. Okay, so that was one thing I wanted to show you. Another thing I want to show you is I hope that you have all become subscribers to our Trader Talks channel. What does that entail? Well, not a whole lot. Just click on that button down in the bottom right-hand corner that looks like YouTube that says subscribe. That's how you can subscribe. Then you can come out here, see what's coming up in the day, see what maybe the playlists look like. If you want to go back to last week's class and look at the setup of SLB and what our conversation was. That was the trade that we're following today that we put on last week. That's a great way to be able to do it. Become a subscriber, then just come on the playlist, and then you can go down and find that long diagonals class, which I haven't looked to see where it is today, but it might be down a little bit lower. I'm actually advanced option strategies. I don't know if that's it or not. I don't think that's it. Anyway, come out and find it. Okay, it makes it so much easier for us to find our content if you do that. Okay. When do we exit this? Mega wants to know from this position we put on. The ideal scenario is that it runs up to our short leg, and we get a little bit of time decay, we get a little bit of increase in the price, and possibly the implied volatility in the longer dated option. It's typically not something that we might be out of by the time we meet together next week. My expectation is we'll probably be in it for a bit, but the idea is we would love for it to get up to that 195 strike. And, if you go out here to let's come back here real quick to, we'll come back here and we'll come back to the risk profile. And let me say, show all, that's our position. Right, here is the peak profitability at options expiration. The magenta line is as of here, but say it went to 195 next week, you could come out here and say, okay, in a couple of weeks, what will my profit be? If you're happy with it, then you might close down the trade, or you might say, oh, great, let's go roll that option. Let's go sell some more premium against it. Maybe go a little further out. Then maybe the next time we go out to 200. Okay, so it's one that I expect for us to be in for a bit of time. These are more complex strategies, and so I don't want to put too many trades on at once. Okay, I don't want to bombard you. I want to have us thoroughly understand the approach for this particular strategy. All right. There were a couple questions I wanted to address, but I am running out of time. Let me see if I can verbally address them. I had a request from Thea about some scans relative to the S&P 500. So Thea, I built a scan for you I wrote for Thea. So Thea, if you're here on the recording or live, take a quick look at this scan. I basically said, let's look for stocks of at least $10, kind of weed out those low cost stocks, and looking for stocks that are up at least 50% in the last 252 bars, which is basically a year. But it would go from January 15th of last year to January 14th of this year. Okay. To see who the performing stocks are. And there's a ton. There are a lot out here that performed better than 50%. You could pick a higher percent and whittle that down if you wanted to. All right, Dom, I'm going to have to get to your question in another way. Okay. Don't have time to answer your question in here, but I did give it some thought, but I just do not have time to go into all the details for it. Okay. But stay tuned. Maybe it's something I can tweet about and give you a little bit of some information on. All right, you guys, my time's up. Got to get out of here. Appreciate you being here. If this was helpful discussion for you today, hit the like button on the way out. Follow Ben and I on our X account, Connie Kelsey us, Ben Watson CS, and then make sure you subscribe to the Trader Talk so you can find our content. So in top of the hour, 15 minutes, Cameron May is going to be here with investing in dividend stocks. It's a new class, I should say, for our schedule here. All right, you guys, we'll check back on these trades next week. We'll see you then. Bye-bye.